All right, hopefully you've had a chance to download your own copy of this exercise so we can work along together. So we're illustrating the first step of the accounting equation that we just talked about, where we're going to identify if a transaction has occurred, and then what's the impact? What accounts specifically are impacted? All right. So here we have Mr. and Mrs. Dursley. They invest cash into the company, into their new business called Muggles, which stands for Magic Unduly Generating Grave Lives for Exemplary Surrey Residents. So then let's go ahead and see, do we need to record this? That's the first question. If it has changed the financial position of the company, then we do need to record it. Here, the company has received cash. So yes, it needs to be recorded. So record. Now, at least two accounts have to be impacted. Okay, so one's obviously going to be cash. Cash is going to be impacted, and it's going to be an increase to cash. Then think back. If we want to increase an asset, we do so with a debit. This is just kind of setting us up for the second step in the accounting cycle. Okay, so we're identifying if it needs to be recorded, and then what are the accounts and the impact. Now, here they give us a little bit of a clue. They want the business structure that offers the best liability protection. So think back to chapter 2 when we talked about the different structures, the sole, the partnership, and the corporation. And again, these are the only forms that we're covering in this class. So I know there are other forms, LLPs, LLCs. That's beyond us in this intro class. So the one that offers the best liability protection for owners is the corporation. The reason we need to know that is because we need to know what offset account to use. Since it's a corporation, we're going to use common stock. If it had been a sole proprietorship or a partnership, you would have used something like capital stock or owner's capital, something like that. All right, so that gets increased, and we increase common stock with a credit. And if it helps you, you can always go back to your accounting equation. We're increasing cash. We have to have an offset. So we'll put in the amounts, $30,000 to cash, which is an asset. And then we increase common stock, which is under equity, by $30,000. The same value has to be on both sides. Okay, so we're increasing cash with a debit, increasing common stock with a credit, because those are the normal balances. And if it helps you, after eating dinner, let's read comics. Assets, common stock. Okay, feel free to work ahead and then check, fast forward and check your answers. January 3rd, we looked at 3 office spaces, just looked at them. So there's actually nothing to record here, and therefore we don't have any accounts to worry about. They hadn't committed to a space, they hadn't put down a down payment, right? They're just looking. So there's been no financial exchange there. In January 4th, however, there has been, right? We paid rent. If it just says paid, not on account, but just paid, you assume it's cash. So we do need to record this. Record. And one of the accounts impacted is cash. Cash is going to go down. So sad. So to decrease cash, you do the opposite, you credit. So minus 1,000. And it was rent. Rent is an expense. Expenses lower equity. So we still have the same value on both sides. So important. Expense, specifically rent expense. Rent expense is going to increase, and it does so with the debit. So you're going to notice not just do you have to have at least 2 accounts involved, but you also have to have debits and credits. You can't have all debits or all credits, because then you wouldn't balance. Your accounting equation wouldn't balance. All right, really good practice. Setting us up for our journal entries, which is the second step in the accounting cycle. We purchased office furniture. Yeah, we got to record that. So furniture and assets will increase. Assets increase with the debit. Again, it just says purchased, doesn't say on account, so you assume that purchase happened with cash. Cash is going to go down. To decrease cash, you use a credit entry. And again, feel free to go back to this accounting equation. That's usually where we're most comfortable, right? So start there. There's no reason you can't start there. Eventually, we'll just go right to the debit and credit, right? But for now, feel free to start there. Okay, so we purchased office furniture with cash. So cash went down 4,000. Furniture is also an asset. It went up 4,000. Now this might be odd because nothing happened over on the liability and equity side. That's totally fine. We have the same value, 0, on both sides. Excellent. All right, on to the next one. We purchased a computer and related equipment. It's going to look really similar to that last one, right? We purchased, doesn't say on account, so you assume that it was cash. So cash is going to decrease. To decrease cash, we credit. We bought equipment, which is another asset. Increase, debit. So again, all the activity in this one would happen under the asset section. That's totally fine. Cash goes down 2, equipment goes up by 2. 0 to 0, totally fine. All right. Let's look at January 8th. We performed. I really want you to get in the habit of anytime you see performed, completed, or provided, that is a key word to let you know you have to record revenue. Why? In topic 3.1, we learned about the rules. Revenue recognition was an important one. It says you call something revenue when you've completed it, when you've earned it, right? So we have to record revenue. Revenue's increasing. To increase revenue, you credit. Right? It has a normal credit balance. Falls under equity, 800. Yes. Okay, received cash. Yay, cash. Increase in asset, that's a debit. And you are still in balance. Same value on both sides. Your beautiful little scales are in balance. We performed, so there's that keyword perform. You got to record revenue. Okay, revenue is going to have to increase. We do that with a credit. But January 8th, we got cash. Here we're not getting cash. We're mailing that client a bill. We're like, hey, we did your work. Here's a bill. Please send us a check. So we're not getting cash, but when customers owe us money, that's a customer account that we're planning on receiving in the future, which is an asset. Assets increase with a debit. Okay, so it pretty much looks just like the last one. Revenue's being hit, assets are being hit, but it's a different asset. Instead of cash, like it was in the last one, this one is AR. All right, and again, take your time. You are welcome to pause and work through. I'm going through it quickly, right? Assuming you've already taken the time to go through it. January 13th, we interview applicants for a receptionist position. The receptionist will begin on the 15th and earn $400 every 2 weeks. Great information, but there's nothing yet to record. We remember expense recognition principle says when we benefit from a service, we record the expense. We haven't even hired the receptionist yet. They have not started working. Okay. All right, on to the 15th. The receptionist's first day working. She will be paid $400 every 2 weeks. Now we're going to simplify this and just say so she's getting paid in 2-week increments, right? As of her first day of work, we didn't receive 2 weeks worth of benefits. Okay. So there's no expense to record yet. Okay. Because we're not going to pay her $400 on her first day. We've only gotten 1/10 of her benefit for this amount. Okay, so we're not going to record it yet. On the 18th, we met with traumatized family members and we offered them coupons, but there was no financial exchange there. Took out a small business loan. Yeah, we do need to record that. We got cash. We got some money. Cash went up. So you debit cash, but it's a loan. It's going to have to be repaid. Whenever you see loan, go ahead and use note payable, because all loans have to be documented with what's called a promissory note, where both parties agree to the stipulations of the contract. All right, so what's happening here is you have assets going up, cash specifically, and liabilities going up. Okay, same value on both sides. For that January 20th transaction. Paid utility bill, it says paid, you assume cash. So we need to record that. Cash is impacted, it went down. To decrease cash, you credit. It's for the month of January, so we need to record an expense in January. So your expenses increase, you do that with a debit, and it'll probably be something like utility expense. $500. So let's see what that looks like on our accounting equation. Minus 500 to assets, specifically cash, minus 500 to equity, specifically expenses. Same value on both sides, okay? So we are in balance, hooray. The 29th. It's a good one. Try the 29th. We received payment. So we received cash, received payment, cash is coming in. So we definitely need to record that cash coming in. Notice there's no amount here, but they are referring you back to January 10th. On January 10th, we mailed a customer a bill for $1,600. So your amount is $1,600. It says we received the payment, so we're going to assume that's full payment. This is a tricky one. So a lot of students want to do revenue again because they say, oh, it's a counseling session. But the counseling session was provided on January 10th. And revenue recognition says record revenue when you earned it. So on January 10th, we recorded the revenue already. Don't hit revenue again. You didn't perform the service twice. What you're going to want to hit is the other account you used on the 10th, accounts receivable, your customer account to be received, right? Because now you're receiving it. So you want to decrease that balance. Okay, but that's a hard one for students to see. And I totally get it because it refers you back to that counseling session. So your natural thought is revenue, but we already recorded the revenue. Why? Because of that revenue recognition rule we learned about earlier in the chapter. So what's happening in this one is we got cash of $1,600 and that customer's account receivable went down by $1,600. Zeroes out. So zero on both sides, we're still in balance. All right, but that's probably the hardest one. That and maybe the last one. All right, the owners were paid $1,000 in total in the form of dividends. Yeah, we have to record it because cash went down. To decrease cash, you credit. Dividends, the amount of dividends paid out went up, and that would be a debit. Okay, you have to have at least one debit, at least one credit. And again, if I'm going fast on this part, if you're like, whoa, how'd you know it was a credit? How'd you know it was a debit? That's a good indication you need to practice your debits and credits more. It should feel very fluid by the end of the chapter. So if you're struggling with that, totally understandable, but make sure you're doing things to address it, like downloading that free app, the debits and credits app, and just quizzing yourself. Okay, flashcards, whatever it takes. Here we pay the receptionist. So we definitely need to record that. Cash goes down, which is a credit. Doesn't give you an amount, but we can refer back to the 15th when they told us it's $400 every 2 weeks. This is 2 weeks later. So $400 is paid out. It's for our employee. So it's going to be like wages expense or salaries expense, probably. Let's do salaries. because they didn't tell us her hourly rate after all. And expenses have a normal debit balance. So what that one looks like, such a good review. Equity goes down by 400 and cash goes down by 400. Same values on both sides, negative 400. And then our last one, we received a bill. We have not paid the bill. We're going to pay it next month, okay, for $100. So this is a tricky one because students are like, well, the cash isn't going out until February, so I'll record it in February. That's only true if you're cash basis. In this class, always assume accrual basis because that's what the SEC requires. Okay, so we're using accrual basis, not cash basis. So accrual basis, remember it says, when did we benefit from the service? Okay, so the advertisement ran in January. January is when we got the benefit. The expense recognition principle tells us record expense when you get the benefit. So we're going to record advertising expense this month. We want to increase an expense, that's a debit. Now, what's the offset? What's the credit, right? It can't be cash because we're paying cash February, not January, but it's an amount we owe. So it's going to go to accounts payable. Okay, $100 to expenses, which brings down equity. And then liabilities went up. So all the activities happening under the right side of the accounting equation, that's fine, it zeroes out. And of course, there is zero under assets. You're still in balance. I think it's a really good example just to get us in the mindset of the impact to our accounts and the underlying accounting equation, especially before we go on to that next step in the accounting cycle. So take a minute, review this. If you need to kind of step back and practice your debits and credits more, please, please, please do so. All right, I'll see you in the next video.